Reduction efforts are concerned with minimizing the severity of a given loss. For example, during a flood at a circuit board assembly plant, quick action to implement protective measures such as moving inventory to higher floors and securing all perimeter openings, and salvage efforts such as immediately cleaning debris from the circuit boards can limit the extent of the damage and reduce the overall cost of the loss. Likewise, fire sprinklers may prevent the spread of a fire from its point of ignition in the warehouse to the assembly line and may actually extinguish the fire. Controlling risks using separation means that an organization will organize its activities or disperse its assets so that no single loss can completely disrupt its operations. For example, an organization may have a policy that prohibits key administrators from flying together on the same airplane. Most organizations recognize the need to have duplicate computer data with frequent backups stored off-site in the event of a system failure. For a chain restaurant operation, other examples of duplication would include alternate vendors for food and sanitation supplies with distribution facilities in several regional markets. Transferring the risk as part of a contract may control risks. An indemnification or hold harmless clause may specify that one party to a contract holds the other party harmless from certain claims of losses related to the activities covered by the contract. Such clauses may also incorporate stipulations for specific types and amounts of insurance. Because losses may still occur, even with strong efforts to control them, risk financing options can help an organization to determine how to pay for the losses that do occur with as little impact on continuing operations as possible. Risk financing involves two basic questions. How much risk can the organization retain? How much should it transfer to insurance companies or to some other financially responsible party? For example, is the business prone to small, frequent, and therefore predictable losses? Must it prepare for a rare but potentially catastrophic loss? The answers to these questions help to determine the right balance between retention and transfer. It's the risk manager's job to find that balance. Most companies retain small, predictable losses as current operating costs or through an unfunded reserve. To cover less predictable risks, they may establish a funded reserve and purchase insurance for the larger losses. In the U.S., insurance carriers readily make available a wide array of property and liability insurance. Property insurance covers the organization for damage to or loss of buildings, fixtures, and contents due to either a specific list of perils, such as fire, flood, or earthquake, or it may be written on a contract that covers damage or loss for any reason except for a list of specifically excluded perils. Property insurance can be written to cover the depreciated value of the property or the full replacement cost. Property insurance policies can include reimbursement for loss of revenue from an insured business interruption and extra expense to reimburse additional costs that an organization may incur in order to maintain operations or to expedite recovery. Specialized forms of property insurance include builder's risk insurance, which is designed to cover damages during the construction of a facility, crime insurance, which is designed to insure against direct loss of money, securities, or similar property due to theft or forgery by an employee of the organization, and kidnap and ransom insurance, which is used to pay the costs of negotiations and for demands during a kidnap incident. Other specialized forms of property insurance include fine arts insurance, boiler and machinery insurance, valuable papers insurance, vehicle insurance, watercraft insurance, aircraft insurance, mobile equipment insurance, and transit or cargo insurance. Liability insurance covers the organization for defense and settlement costs associated with the activities and operations of the organization. The most common liability insurance for business is commercial general liability insurance. This type of policy provides protection from a third-party claim for negligent acts or omissions from the operations and the premises and from non-professional activities that have resulted in bodily injury or property damage. Such a policy also covers personal injury claims, such as libel and slander. There are a number of specialized forms of liability insurance, including auto, aircraft, or watercraft liability policies, each designed to cover losses to third parties arising out of the operation of a motor vehicle, aircraft, or watercraft owned or operated by the organization. Professional liability insurance is designed to cover the organization for claims alleging injury or damage arising from a breach of professional standards. Commercially available professional liability coverages include medical, dental, legal, accounting, architectural, engineering, notary, realty services, social work, including policies for counselors and such, and fiduciary, for loss arising from the failure of the organization to properly act with regard to employee benefit plan assets. Most commercial insurance is purchased through a licensed insurance agent or broker. While there is federal and state regulation of insurance policy provisions, the policies can vary significantly from carrier to carrier in how much coverage is provided. While some organizations make the insurance purchasing decision solely on lowest premium cost, a risk manager is more likely to purchase insurance based on a combination of factors, including the quality of the contractual provisions, the loss control services that the carrier may provide, the claims paying reputation of the carrier, and the insurance carrier's financial strength. Developing alternative plans and recommending appropriate strategies are principal responsibilities of the risk manager. Complicating the task is the cyclical nature of the insurance market. The market fluctuates between hard and soft conditions based on external factors that affect supply and demand. High interest rates, for example, promote soft markets. Insurance carriers benefit from high investment income, and competition lowers prices, while broadening the range of coverages offered. Low interest rates, on the other hand, or a spate of disasters would cause insurance prices to rise and would shrink the available range of coverage. In this later scenario, risk managers must be capable of guiding their companies through the alternatives of self-insurance or going without any insurance. But self-insurance is only one response to cyclical markets, and it's an imperfect one. Funded reserves are hard to maintain at levels needed to cover unexpected losses, and they are generally not tax deductible. Many corporations, alone or in groups, have set up captive insurance subsidiaries. The rationale for captives, as well as their structure and administration, is still another specialization of the risk manager. Functioning like insurance companies, captives typically fund the first or the primary layer of insurance and turn to the excess and reinsurance or wholesale markets to absorb the larger losses. They may also assume risks of other companies for a premium. This pools the risks, further spreading them, which can help a captive become a profit center in itself. Once the risk has been identified and evaluated, and the options have been analyzed for effectiveness, we applied the best options to manage the risks. Two questions may serve in guiding the third major component in the risk management process toward the best solution. What techniques or combination of techniques will be the most effective? What techniques or combination of techniques will be the most economical? Developing a response to these questions in conjunction with one another will take into account all the variables that can affect the success of a risk management option. For example, a transportation company with a large fleet of trucks has several options available for use in managing its auto exposure. It can buy commercial auto insurance, self-insure either or both the physical damage and/or liability, develop a fleet safety program that includes driver training and driver record checks, outsource its vehicle needs, lease rather than own autos to transfer the exposure, or form an insurance pool with other transportation companies. All of these options or others could work, but the best solution for the transportation firm would probably be a combination of risk financing and loss control. Buying or self-insuring is dependent upon the available financial resources, and loss control efforts are dependent on both human and financial resources. The final options selected are usually driven by both. This third component in the risk management process may only require the person in charge of the risk management program to make decisions because the choices are technical in nature. Other options may require that risk management elicit the cooperation and assistance of other managers and employees at the firm. Monitoring the effectiveness of the selected options is often minimized and sometimes even overlooked. Risk management options can be put into place, but still not adequately protect the organization. Following the implementation of an option, periodic reviews are necessary to evaluate the choice to determine if any modifications might be needed. Like the rest of the risk management process, there are a variety of ways to monitor an option for effectiveness. The basic formula includes establishing an acceptable level of performance for each option, comparing what actually occurs with the established acceptable level, and making adjustments to the option to ensure the established standard is reasonable. The risk management process is designed to be both repetitive and self-reinforcing. The challenge in risk management is to continually assess the activities and operations of the organization to determine if the risk control and the risk financing practices that have been put in place continue to adequately protect the organization, or if modifications need to take place. With such a wide-ranging set of criteria, who are risk managers? Effective risk managers are resourceful, interdisciplinary generalists relating to every aspect of the organization. Effectively sensitizing and influencing management involves having sound knowledge of the business and its philosophy. This may be acquired by visiting all locations in order to learn about their operations. They must be able to interpret developments in their employer's fields in finance and information systems. They must be effective consultants, motivators, problem solvers, planners, and forecasters. A sound knowledge of insurance fundamentals and risk financing mechanisms is essential to being able to ask important questions such as these. What potential losses can be retained through some form of self-insurance? Which ones need to be insured, and for how much, and with which vendor? Are claims being handled properly? Is appropriate coverage available? The risk manager must also be adept in loss control concepts such as employee health, worker and product safety, property safeguard, fire prevention, and environmental protection. Above all, they need business common sense. Where do risk managers come from? Many come with degrees in management, law, finance, or engineering. A growing number of universities are now offering degrees in risk management. Some risk managers have worked in the insurance industry. Most have undergone training in such areas as asset management, computer systems, contracts administration, employee benefits administration, environmental law, loss adjusting, marketing, industrial hygiene and safety, quality assurance, statistics and probability analysis, and taxation. Once in the field, many complete professional accreditation programs such as that of Associate in Risk Management or Certified Risk Manager. They stay current through conferences and continuing education programs of associations in the United States, such as the Risk and Insurance Management Society, Public Agency Risk Management Association, University Risk Management and Insurance Association, the National Safety Council, the National Fire Protection Association, and many others. The International Federation of Risk and Insurance Management Associations, the contact information for which is available in the bibliography section of your participants' manuals, can provide you with information on similar associations that may exist in your region. Originally concerned only with insurable risk, risk management matured and broadened in the 1970s and 1980s. Technology, capital concentration, product and worker safety, environmental concerns, political unrest, and global economic interdependence all increase the sophistication needed to protect physical assets and people. In this vastly larger arena, every type of risk now falls within the domain of the risk manager. The scope of risk management is still expanding, helping organizations adapt to an increasingly complex and competitive environment. In the years ahead, broad social forces will continue to change the face of free enterprise and impose new challenges for risk managers. They will need deep reserves of flexibility, inventiveness, and technical know-how as organizations struggle to maintain productivity in a topsy-turvy business world. But a growing force of highly trained risk management practitioners is evolving, a powerful coalition for economic efficiency and safety. Risk management creates opportunities for you to use good business judgment and common sense. It requires that you identify your organization's potential hazards, analyze the effects of a loss, and apply the apparent best combination of techniques which will eliminate, control, retain, or transfer the losses. The risk manager must have the technical know-how to make the right selections, but accidents do happen. So risk managers ask themselves and others, what if? These what-ifs become the basis for contingency planning. Ideally, every organization should have an emergency response, crisis management, and business continuation plan. The risk manager should be an integral member of the team that establishes and keeps a contingency plan battle ready. Risk management is not only for large organizations with ample resources, nor is it a concept applicable only to an industrialized economy or environment. It is a key global strategy that enhances value and provides a financially stable environment for the success of corporations, educational institutions, and governments anywhere in the world. The risk manager is a new generation professional essential to competitive organizations in this new century and millennium. We must all review our priorities to make sure we are giving the appropriate attention to this new visionary managerial activity.
John, thank you very much for those comments. And let's begin now with our first question and answer session. We'd like to answer as many questions as possible. Therefore, we ask that only one question be asked per phone call, and these questions be as brief as possible. You may call the studio directly at the phone numbers or fax which appear on your screen. We remind you to make your calls at a distance from the monitor to help avoid feedback. Thank you. And our first question today comes from the Federación Nacional de Comerciantes in Medellín, Colombia. And the question, gentlemen, is this. Risk management sounds as if it's all-inclusive of an organization. And the question further goes on to say, how many individuals should an organization have within their risk management departments? John, since you're a professional risk manager, I'm going to ask you to address this one first.
Well, my first response is they should have more than I have. The reality is it's dependent upon the organizational structure of the particular firm or agency that you're dealing with. In my case, I'm a solo professional. I have 2 administrative support staff. A university across the other side of Los Angeles has a professional staff of 45. It just depends on how you organize the department, what functions you keep internally versus decentralize out to the individual operating units.
Since you're a sole practitioner, more or less, what is perhaps the number one thing as a risk manager that you do?
The number one thing that I do is listen to the concerns of my constituents, which are the operating units of the university, the academic affairs area, the fundraising individuals, our public safety department, any department or entity that may have a unique risk that's looking for some assistance. It's their observations, in our case, with our decentralized organization, that allows me to be responsive to their particular needs.
Very good, thanks. And Jim, from the practical perspective in dealing with, not that John's wasn't practical, but from dealing with many organizations across the globe, what do you feel that the number is? Or what are you seeing? What's the reality in terms of the numbers of people in a risk management department?
I've seen over the past few years some increase in the importance of risk management within some of the larger companies, as well as some of the smaller companies. On the other hand, in some cases, I've seen a decrease. I think you'll see both nowadays. I think it's important, though, that they do think about the staffing and make sure they have the appropriate people to address the issues.
Very good, thank you. And we're going to take a call now, gentlemen, from the same site, the Federación Nacional in Medellín, and we'd like to have your question, please.
Thank you. Good morning. Our question is the following. Although there are many different ways and efficient ways to manage risk, how can you identify tolerance to risk within an organization, and what can you do, how can you do that? And what does that entail?
Two aspects, tolerance to risk and then the methodologies to perhaps identify risk, if you will. John, will you address the tolerance piece, please?
Sure. Tolerance is a very subjective issue. It's what I call a soft issue. It's really a matter of asking the senior management team, the stockholders or the Board of Regents, whoever really holds the ultimate control of the organization, what their tolerance or comfort zone is. As an example, when I first started with Pepperdine University, one of the first questions I was asked by our university president was, how much insurance should the university have for liability exposures? And I threw out a very small theoretical number. He said, no way, I can't live with that. And I said, well, how about a number 20 times that? He said he could sleep comfortably at night. And so somewhere in between was that magical number for us. Now, that's not to say that's the most appropriate way of determining the tolerance to risk, but it's one of the methods, and it is always a soft issue.
Okay. Jim, briefly, methodologies to identify risk. Is there something that pops up quick?
There are a number of ways you can identify risk. You can do it internally. You can develop a steering committee to look at your various operations and discuss what those risks are, both natural hazard-wise, where you're physically located, your neighbors, as well as your particular operations. You can also hire outside consultants as well to come in to help evaluate those risks, and there are some very, very good organizations within the country and the world that can help you do that.
Very good. Thank you, gentlemen. We're going to take a call now from some of our friends in Mexico City, and if we may have the question, please.
We're calling from CETIS number 3.
Thank
Adelante. How could you prevent risks within the learning experience on a medium high level in higher educational institutions? How can you manage risk in this environment of learning, academic institutions?
The academic environment, we have John, who's here from one of the United States premier institutions, Pepperdine. So, John, I'm going to default to you on this one.
Well, my candid first response is the simplest solution is to lock the gates and not allow the students on campus, and you've eliminated a lot of your exposure. But you're defeating the core mission of the institution. And that would hold true for a for-profit institution or a government agency. So you have to be careful on what solution you pick, because you might end up causing more problems. The reality is it's dependent upon the organization where it's located. You have to look at your exposures. In our case, physical exposure to our students, our faculty and staff, are relatively mild because we're in a mild climate. We don't have the snowfall problems. We don't have issues with uneven pavement. On the other hand, we live in an area of the United States that's extremely litigious. So we spend a vast majority of our time dealing with liability exposures to liability to third parties, whether it be performance-related issues, educating the students, copyright infringement, libel, slander, proper administration of our public safety department practices. It's all dependent upon the particular situation and scenario, and I wish I could be more specific, but at this point I'm not sure what your institution's particular exposures are, so I'm at a loss to give a more specific answer.
I think it's good, though, because you provide some parameters and thoughts for people to plug into when it comes to how you identify higher academic institution issues, legal, litigation, property. You're covering the spectrum there. So that's very good. Thank you. And it was a great question. I'm going to take a call now from the Colegio de Bachilleres in Sinaloa, Guasave. And if we may have your question, please.